Liquidity is the biggest driver of everything. It's the driver of risk. It's the driver of reward, performance. Everything is about liquidity. Following the flow is just following where the liquidity is going.
Welcome to The Derivative by RCM Alternatives. Send it.
Hi, my name is Bernie Yu. I'm the co-founder and CIO of Patronus Capital, and we're here to talk about options and convexity on The Derivative.
Thanks, Bernie. How are you?
I'm good, thanks. How are you, Jeff?
Good. Where are you?
I am currently in the northern suburbs of Chicago, so enjoying the summer here.
Which suburb for all those Chicago folks?
I am in Winnetka, actually, so not too far from the Home Alone house.
Right?
Yeah.
Didn't that sell recently, like a year ago or something?
Yeah, it's constantly turning over. I think it's probably turned over two times since we've been here.
Right. I think someone wanted to buy it and make it like a Airbnb, right? That would have been, you could stay there.
Yeah, that would have been neat. I think the council has put a fair bit of regulation around it, though. So.
Great. Well, give us a little background, how you got started, how you got in the biz, and then we'll dive into the strategy.
Yeah, so I went to school in Australia, in Sydney, New South Wales. I studied actuarial science and financial economics. Had my plan to go into the insurance business, and one day a trading firm was doing like a recruiting drive. They were handing out these red t-shirts, and I wanted a free t-shirt, you know, being in college and whatnot. Try to get your hands on anything free. And so they were saying, okay, if you can do this 80 question quiz in 8 minutes, we'll give you a free shirt. So I did that, passed, and got into...
What kind of questions?
They were just basic arithmetic and pattern recognition questions. The emphasis was on speed and making sure that you could just get through all the questions. So the trading firm that I started working at in 2012 was Optiver, and that was in their Sydney office. So I was there trading, started on like Hong Kong equity index options, and then moved over to the single stock options, worked a little bit with the JGB options. And then, you know, in 2014, there was like this push to get traders over to the US office because they thought rates were going to go up. Anyone that had a little bit of rates vol experience, come over to the Chicago office. I didn't know much about Chicago at all. Back then, I knew Michael Jordan and the Bulls. That was about it. And I came over in January 2015. So that's how I kind of came over to hit this side of the pond, if you will.
And so you're Australian?
I am Australian, yeah. I was born in Canberra and then raised in Brisbane. So,
nice.
Yeah.
We're thinking about going back next Christmas. My wife studied over there in Fremantle, and we've been over there.
Oh, perfect.
2 times.
It's a long trip. It's a long trip.
Long trip. Well, that's why you got to go at Christmas. You get 2 weeks with the kids. Yeah. So that blows my mind. So Optiver just said, hey, we don't care about, we're just going to go around campuses and hand out these quizzes and see who passes it. That's our...
Yeah, exactly. I mean, I'd seen in previous years people wearing these kind of red shirts. That was the thing. So the university I went to is UNSW, and people had these red shirts. And I was, just looking out for free stuff, college kid. And Optiver, part of their marketing campaign was handing out these red t-shirts. And so that's how I got hooked. Like I said, I had no intention of entering into the financial markets and trading. I came from an actuarial background, so I was very much focused on insurance, that kind of risk.
Thank God you got out of there.
Yeah, it's a lot more interesting, should I say? It's a lot more interesting.
And what's your Australian thing you do? Do you surf or do anything cool like that?
So I would say
swim with
my
sharks.
brother and I were probably one of the first like ethnically Chinese participants in cricket. A lot of people who like it's quite predominantly played by the subcontinent. So a lot of Indian and Sri Lankan is very popular there. Like in China, cricket's not a thing there. And then as my parents as immigrants, they didn't really know about it. My dad studied in the US actually, so he didn't really know anything about cricket. So, but he wanted, and my mom wanted us to kind of assimilate to the culture and just try, quintessential Aussie stuff. Cricket being one of them. So yeah, I mean, my brother played, at a pretty high level. So that was like one of the cool, quirky stuff about us. But apart from that, Aussies, we love sports. We're pretty chilled. So there's nothing too special or unique. Unfortunately, I think I've acclimatized to the weather here, so I'm less used to the heat and the humidity.
Yeah.
So, but yeah, no, I love the beach. I love the salt water. It's weird, swimming in Lake Michigan. It's just not the same.
You piqued my interest there with JGBs. Like what did and what do the options look like on those? It's got to be a weird market being so kind of pegged all the time.
So JGBs in 2014 is probably very different than what JGBs are like today. The options market, it was highly, highly professional, right? You don't have any retailers in there. They were massive contracts, slow moving, very one way, very flow driven. And you just had to kind of be very diligent about managing your risks as a market maker, because you had to take down the inventory and you had to move quickly to try to get out of any toxic flow. So it was a very different style of trading compared to Hong Kong single stock options, where it's, you're trading 50 names and you're just trying to spread it off, lay it off. There's a lot of liquidity, a lot of different risks to manage. Whereas with the JGB options, it was kind of very concentrated, very flow based. You had to know who the players were, speak to the brokers, understand that. So it's a different style of market making, which definitely helped.
Yeah, always at risk of the government or the central bank coming in and saying something, and boom.
Yeah. I think right before then, the reason why it got a little bit interesting was with the whole Abenomics, just unleashing all that stimulus. I was also part of, I traded a little bit with the Nikkei team as well, and just watching Nikkei just uptick during that period was wild as well, and just seeing those correlations between the equities and the fixed income side from a vol perspective. That was very interesting.
You could almost argue it did you a disservice, like learning in the JGBs, right? Of like you weren't seeing massive volatility in flows; it was just slow moving.
Right. Well, initially,
also,
when I came over to the Chicago office, I initially traded on the U.S. Treasury market options. And that was more akin to the single stock option. There was a lot more liquidity, a lot more turnover, a lot more flow, capturing that down. And then towards the end of 2015, I moved over to the Eurodollar desk at the time. There's no more Eurodollar product now. It's now SOFR. And I was market making the short-term interest rate options there. That was more akin to JGBs, where it's heavy one-way flow. And you just have to understand the price at which you're buying or selling, and you either hope that it reverses out so you can take your scalp, or if not, like just know that whenever you hold to expiration, that's the variance that you're going to run, and hopefully you ask for enough of credit to take on that position, to take on that risk.
And then let's back up a step. I'm sure people know the Optiver name, but maybe not exactly kind of what they were doing. And how many people were doing it. So maybe give us a little quick background on Optiver.
Yeah, so Optiver is so to be clear, so I no longer work at Optiver anymore. Yeah, but Optiver, it's a Dutch trading firm. They started off in the 80s in Amsterdam. Optiver Optiver stands for like options trader. That's how the name came about, and its bread and butter is market making. Primarily in the option space, they've branched out to, when I was there, branched out to market making futures, and we call them like Delta One strategies. The whole ethos of Optiver was when you trade, it was learn the philosophy of trading, learn the philosophy of market making, and you can take those skills and transfer them to different desks. So if you were an options market maker on Hong Kong single stock options, one day, the next day you get plonked on the Japanese government bonds, which is quite different. So long as you abide by the same philosophy, you'd be fine. If you plonked over, you moved to the Chicago office and started trading US Treasury options, you'd be fine. And so it was understanding how we made money, which was just market making, taking down the bid-ask spread, providing liquidity, providing that service to anyone, to all hedgers and speculators in the options market.
And maybe not to dumb it down too much, but explain market making real quick too. So it's right, and you're the modern equivalent of the old floor traders in Chicago, right?
Right. So market making, the best example was when we were kind of doing our marketing campaign. You can think of it as a grocery store. The market makers at the grocery store, where you have, farmers that need to like sell the products to the grocery stores, and then you have the consumers that need to buy the produce from the grocery stores. And then the grocery stores are there to create that market for people to buy and sell. And, take Whole Foods as the grocery store, for example, like that, when they're going to be open. There's always going to be that liquidity there. If they didn't have the grocery store, you'd have to know when to go to the farmer, what time they were available. The farmer would have to know when the retailers would come, the consumers, the end users would have to come. And so there would be constantly this liquidity mismatch. Enter the market maker or the grocery store, and they're there to constantly provide liquidity. And because they're providing that service, the idea is that they get compensated for that liquidity providing.
But grocery stores are notoriously low margin business, right? But same with market making, very low margin, just do it a lot of times.
Yes. So the spread relative and to the turnover, yes. I mean, they are quite low margin, especially when you compare to, say, value funds, right? If you think about Warren Buffett's, Berkshire Hathaway, right? The margin that they have, the amount of, if you will, edge whenever they go by, way back when he bought Coca-Cola, like what was his valuation? What was the price that he was entering? That difference, call that edge, call that margin. Yeah, it's probably 100, 1,000 times greater than each trade of a market maker. The difference being is that while it's low margin, it's high volume. And that's kind of, it's the combination of the two which gives you the revenue.
So then we buried the lead here. So then you start Patronus, your own baby here. So what did that look like? You said, I've learned enough, I'm ready to go out. What was the impetus to go out on your own?
Yeah, like I learned a lot from Optiver, and they were really good to me. And, I learned a lot. I good chance to give back as well. We picked up a lot of interns, but at that stage, I wanted to, scratch that entrepreneurial bug. I wanted to go out and be my own boss, do my own thing, have my own schedule. I had to think about, what assets did I have, like mental assets, right? Like what edge did I have, et cetera, et cetera. And then my partner, he was like, I've got a family office that's willing to seat us. If you're interested, let's think about maybe, if you want to set this up. So he decided to leave in 2019 to set up all the legal work. I was, thinking about it. And then basically I had my first child in March of 2020. So the markets went wild. I decided, to give my leave and like, okay, this would be a great paternity leave. And then I onboarded with Patronus in May of 2020. And so we kind of started everything together. Our initial intentions at the time, and I think what he was doing initially when the fund started was a little bit of macro, a little bit of interest rates, because we traded the Eurodollar desk together. And rates went to zero. There was no more interest rate volatility. So we pivoted, right? We started trading just other kinds of volatility strategies. we did a little bit of short VIX at the time. We did a little bit of directional biases on gold and yen, and we tried to just explore and see what would make money. And then we ended up settling on trading just S&P 500 volatility. It's highly liquid. Vol was relatively high back then. There was a lot of opportunity in the traditional market making space, that we had learned at Optiver. And so at that time, I decided, okay, let's just hunker down, let's stop exploring, and let's stick with market making style of investing on the S&P 500 options. And we've been doing that ever since 2021.
So explain that market making style. What do you mean by that?
Yeah, so when you think about market making, the typical hold time of your positions can go anywhere between, microseconds through to a couple of days, maybe a week or two. What we do at Patronus is we try to extend that holding period of time to 2 to 4 weeks. And then that's kind of the bridge between your traditional asset management, which is long-term valuation, buy and hold, etc. So we try to marry asset management with market making. So that's why it's market making-esque, with the essence of staying flat risks, looking at your risk table, trading the entire board of strikes that's available, seeing what has excess supply and demand, and honestly, like supporting the market makers in terms of the liquidity that's being given to them.
And then, so as it developed, not necessarily long vol, not necessarily short vol, you're just in there in the middle. What would you call yourself? Relative value vol or vol arb?
Yeah, so when we started, that was really what the name of the game was. Basically, what we did was we created 2 volatility models. The first volatility model was the market volatility. If I needed to go get a price for a call spread or put spread, I knew exactly where the market would make that and what my entry and exit costs would be. Our second volatility model was actually our edge generation. Where should the market be? And having the difference of those 2 models allowed us to market make in the sense that we knew where the prices were, but then having that second model, being able to disagree with the market and then actually take on positions and invest over a longer time horizon than a traditional market maker.
And so when you're considering that with all the different market makers, right, you're not just, we should take a step back. How many Optivers in the world are there, right? Like 5, 6 big firms doing this similar things?
The major players, there's probably 3 to 5. I would say the top tier, there's maybe 3, and then second tier, there's probably another 2 to 3. And then you have a plethora of, smaller groups, although they're kind of being swallowed up now by the larger groups because they have the infrastructure, because they have the access to flow.
And do each have their own twist? So when you're trying to make your own value for that spread, as you said, you're saying, here's what I think the market makers would value that as?
I would say, this is purely speculation because I've never worked at another market making firm, but talking to like floor traders, because they always talk amongst each other, I would say 90% to 95% of the time there's a consensus, especially on what the market price should be in terms of what inventory to hold, in terms of what positions to actually keep and to dish out. Then that consensus probably drops down to 60 to 50%. But there generally is a consensus amongst market makers, and that's just simply boils down to the flow.
And the flow, explain what you're looking at in terms of flow there. So retail, institutional, the market makers themselves.
Yeah, so it's we follow a lot of people like on Twitter or X nowadays, just putting out like what kind of flow is coming down. I personally like to follow a lot of ETFs that have options embedded into them. We do see that flow coming through, especially in the pit now, because like the broker has more color now, and we can talk to people around, to say, okay, what kind of institution is doing this, what kind of size, how often, what conditions do they stop the flow, and I think that's really important as well. And the classic one is like, you have someone who likes to do like the buy right strategy, just come in and sell as call. There are other, quote unquote, more sophisticated people who try to sell a call and then buy a put spread, and then finance that, right? I think JP Morgan has a very large ETF that does that.
Yes.
There are other, I think, starting at the end of 2021, beginning of 2022, there was this large fund that was selling a lot of the far downside, like Delta 5 puts. And that, it's just understanding the flow, when they start, when they stop, and, behavioral economics comes into play. Why are they doing that? What's their mandate, right? Et cetera, et cetera. So that's part of the game that market makers have to understand. So you don't, you try to avoid to buy the first level, you want to buy the last level, et cetera, et cetera. And as Patronus, that's kind of what we do as well. But what we try to do is strip out the need for that infrastructure, that heavy overhead, and, forego the quick instantaneous money, the high turnover that requires a lot of overhead. We sit back, let the dust settle a bit, and then we kind of say, okay, where has there been too much supply, too much demand, and let's support the market.
Taking a step back, the JP Morgan hedged equity, I believe, right? It's like 28 billion something. Yeah, that's a good example, because it makes sense to people of like, hey, here's this 30 billion, call it behemoth. In their prospectus is what they need to buy and sell. It seems an easy trade to kind of get in front of those trades, but I think it's much more difficult than that. They kind of hide their size, they do different things, they use different market makers. So like, talk to that for a second of why that isn't as easy of a trade to just trade that flow as people might think.
Yeah, because I mean, if you take on that, if you were the sole market maker, right, the sole liquidity provider behind that, there are a lot of Greeks.
No thanks.
You're buying a lot of premium, right? There's a lot of curve risk that you're buying. There's a lot of all these different things that a traditional market maker doesn't want to house on their books. And so they have to adjust for the right price. They have to adjust for the right timing of it, because these guys that are selling it, they actually don't bear any of the risk. They just sell it and forget it, or like execute it and forget it, right? It's actually the owners of the ETF that bear the risk. Right. And so for the market makers, for such size, they have to price that appropriately, and making sure that if there's opposing flow that's naturally coming in as well, then they can be more competitive. If other people start like copycatting, there's a little bit of copycatting going around. If there are more copycats, then the price that they have to ask for is going to be a little bit more skewed than normal. And so that's why it's not so easy. That's why, it's not arbitrage, it's not front running, because there is risk. They might stop, on one particular day. It's all guesswork, it's all probability, it's all chance. And at the end of the day, what everyone's trying to do, and this is why it's like the perfect capital markets, is just to get the best price for the level of risk that they're taking on.
And then for you guys, you're saying, so it's one, understanding that flow, but two, matching it with your valuation of, okay, exactly, we think this is oversupplied here, given our model's valuation, we're going to sell into that, or we're going to buy it if it's oversupplied. Yeah,
so what we tend to do is, and we've learned, a lot about this, and this is kind of where the convexity piece comes in, is that when convexity is cheap, you should buy it. When convexity is expensive, that doesn't necessarily mean you should sell it. And you want to buy something that's cheap, but you don't necessarily want to sell something that's expensive, because it could get even more expensive and even more expensive. And that's when things can get a little bit hairy, right? But yeah, it's understanding the flow and what people have natural tendencies to do, right? Like a lot of typical short funds, they'll sell strangles. They don't sell straddles, right? There's a lot of wing selling, right? So if you think, a lot of the buy right, that's selling calls, but those calls are rarely at the money options. They're always upside. And then if you think about like put selling, yes, you do have some funds that sell a little bit of at the money, but a lot of them sell the far downside. So when you have a look at this, it's there's a lot of flow which is pushing the wings down. And so there are definitely opportunities out there where you can buy this far convexity, I would say global convexity, quite cheaply. And so that's like that's like a new strategy that we've kind of created, where we really isolate that cheap convexity, not local convexity, but I call it global convexity. So protecting your portfolio down 15, 20, 30%.
And talk through exactly what you mean by convexity in that case.
Yeah, so the classic form of convexity is owning a straddle, where your payoff is like a V shape. And so when you talk about like a mathematical function, you can think of it as it's like a U. It's like if you go to the right, it goes up. When it goes to the left, it also goes up. So whenever you have a portfolio that has that kind of a payoff, then that's called long convexity in your portfolio. The problem with convexity, and why a lot of people try to avoid it, is because you usually have to pay for it and pay a lot for it, right? And so if nothing happens, your payoff, you lose a finite amount, but it is finite if nothing happens, and then you need that movement in whatever you have that convex exposure to make money.
And so you're not considering the acceleration of the move as cheap convex, or you are in a bit.
So what we try to do is, instead of getting into a U-shaped payoff, we try to get into a W-shaped payoff.
All right.
Right. So what that means is, we have a little bit of concavity in our portfolio locally, which means that, look, if nothing happens, then we sit and we're able to collect a little bit of premium. If something moves a little bit, then we rebalance, and mark to market, you might take on a little bit of a drawdown, because there's no such thing as like free arbitrage, right?
Yeah.
And then if you really start to accelerate, then that's when really things start to pay off. And this idea really comes down to the ability to replicate an instrument that kind of gives you that flat payoff locally. So locally, you're not even convex nor concave, and then globally you are convex. So it's kind of like a flat U payoff, which kind of looks like a little bit of a squiggle of a W. And those are the kind of payoffs that we're trying to replicate at Patronus.
And globally versus locally, you're not talking markets, you're talking on the curve and like locally around the money.
Yeah, on the size of the move for the particular future, which we're talking about is the S&P 500.
Right. And so locally is around the money and globally is out of the money, exactly. Either direction.
Yes, exactly. Yes.
Love it. And how do you not fall into the trap of it's cheap because, right? Convexity is cheap because it's such a low probability of happening. So, right, I can argue it's cheap for a reason, or it's inexpensive for a reason. And then it gets into the difference between inexpensive and cheap.
Yeah, so a lot of the reason why it's cheap is because of the flow. And quite often we see either the day of or the hour after or the next day after that flow has been executed, when that level of convexity gets quite cheap. And then what happens is, let's say market makers try to anticipate that, and for whatever reason the customer decides not to sell the convexity, then people have to chase that, and then it gets quite expensive again. So, and that's when you don't want to sell it. You just you let it ride back down to cheap levels. And the reason is because like that, convexity, just like volatility, is unbounded on the upper level, right? So we try to, from a risk adjusted perspective, try not to ever be short risk as such, because from a risk adjusted perspective, it doesn't make sense.
And how do you define risk in that case?
In that case, we look at like down a couple of levels. So one measure that we look at is what the span margining requirement. So we predominantly trade on the Chicago Mercantile Exchange, and they have their span margin calculation methods, which is they have a matrix, I think, of like 16 different scenarios, and then they take the worst one, and that's what your capital usage is. We look at that. We look at value at risk over 1 day, over till expiration, and then we look at down 32%, strike vol up 25 vol points. And then we just have to stay long those in the down scenario. So it's that down, it's mainly the downside where we try to make sure that we're always positive.
And then switching gears, somewhat related, like how do you feel most groups get in trouble with this kind of approach, right? A lot of relative value. I'm short this part of the curve, I'm long this part of the curve. And invariably that short part loses way more in a spike in an April kind of move than they were anticipating. So
Yeah,
kind of
so
yeah, go ahead.
yeah, we got into a little bit of that pinch, and this was that learning experience. And it's this idea of when you're either locally convex or you're locally flat, but globally you're actually concave. And then that's when you can get into a little bit of trouble. So for example, you might think that if you have a put 1/5 on or 1/3 on, you might be flat. You might even be long a little bit of gamma, right? If you move around a little bit, because you own that one leg that's closer to the at the money.
Yeah.
But if something really bad happens, and it happens really quickly, and you can't hedge, well, then you get very short quickly. Your portfolio becomes quite concave. And it's this idea, it goes back to the basics of options pricing, which is the ability to hedge, continuously hedge, right? That's where the Black-Scholes formula came from, your ability to continuously hedge. And when that ain't so, that's when people get into trouble.
I love it. That's a good Aussie line. When that ain't so.
Yeah.
So I think it was August last year. There was a bit of an event there, right? So short gamma got taken out again here in April. So and you guys you'll go to the sidelines, right?
So what we usually do is we will, let's say right up to August, we didn't have that big a position. And the reason why was because, we were just constantly tricking up. There wasn't that much disagreement in the market. The flow was fairly stable. And then we had a little bit of a position on, but then once the index fell, I think it was a liquidity issue in Japan that kind of precipitated everything. That's why I was quite short. There was a little bit of a dislocation. And then once the convexity was cheap enough, because it's somewhat counterintuitive, but as instantaneous volatility goes up, so you're at the money, volatility goes up, usually the price of volatility comes down. And so once that vol of volatility comes down, it can come down to a point where the price is quite nice to own the vol of vol. And that's what I kind of call, to the layman, like long global convexity. People, there's like VOMA, that's another Greek that you can use to describe that. But the idea is you stay locally flat, concave or convexity, and then globally you get long convexity.
Yeah. So using all your Greeks, what does that look like in terms of Greeks?
So yeah, we try to stay flat, Vega, Gamma, Theta, Vanna to a certain point, like in terms of our derivation of Vega as we move around as well. But then you can get long VOMA, which means that as vol goes up, you get longer Vega. As vol goes down, you get shorter Vega. So I like to think of it as the gamma of the at the money vol.
Love it. And then
that's where a lot of people who are selling that stuff get unstuck. And that's where I think there's quite a nice opportunity for us to kind of reset that price and say, like, look, you should actually be selling this for a higher price because you're selling it way too cheap right now.
So that's where everyone's looking to get out, and you'll raise your hand and be like, okay.
That's when
I can make a market.
Exactly. Yes, exactly. Yeah.
And so totally focused on S&P right now?
Yes. So we're a four-man shop right now. Our focus is, solely on just making sure that what we do to the best of our abilities. We've got 3 strategies running right now that are independent, that source alpha differently. But because the S&P 500 is so liquid, because the CME, it's such a powerful exchange in the sense that it has a lot of combination strategies where you can piece together call spread versus put spread with an extra tail and things like that. The liquidity provided there is amazing. And so for the time being, we're just going to keep maxing that out.
And what are you across the board? 0 DTEs, weeklies, monthlies, quarterlies?
We primarily launch positions with an expiration between 4 to 8 weeks, and we will hold them to 2 to 3 days left. The reason why we don't play in the 0 DTE game is I had a look. It's pretty efficient from a positional standpoint. So if you just wanted to come in and take markets in 0 DTE, because there's so much liquidity, just going back to regular like capital, efficient markets hypothesis, it's pretty efficient. Where it's quite profitable for the market makers is because of the high volume. If you can capture the bid-ask spread, that's when it becomes quite profitable. But we stick farther dated, which for a market maker is quite far dated. But if you go to like a bank, anything under 6 months is considered quite heavy gamma, which for a market maker, that's very different because heavy gamma is like day of.
Right. Yeah. What's your, just sidebar for a minute on 0 DTE? You mentioned highly efficient. Do you think was it 2 years ago, everyone was saying this is going to be a blow up risk and there's all sorts of unknowns here? What's your thoughts? It just is what it is?
I think that it is efficiently priced at a global level. There are definitely pockets where it becomes inefficient. I think I think hedges are misusing 0 DTE options. I think they leave themselves. So if you think about managing global convexity, there's also a time component. You don't just want to be globally convex when there's an event. You also want to be long convexity when it's cheap, when it's quiet, when you don't, think to own it. And so people can get into a bit of trouble when they have this quote unquote buttoned up risk strategy. But if something just randomly happens and they don't have it because all they do is buy this heavy theta 0 DTE stuff, then they can be caught a little bit offside. For example, like Liberation Day, the straddle going into that event was, I think, like 20 or 30 ticks. It was basically like 0.5%. And we moved like 3% on that day. Yeah. So if people aren't buying that, because people weren't pricing it. People weren't pricing just how much we would move. And so when if people are constantly buying 0 DTE options to cover their risk to get long globally, convexity, it's quite expensive. You're better off just buying a 1 month out, a 2 month out, a 3 month out. And I think a couple of risk managers are forgoing that, and they're trying to be a bit cute and clever with it and saying, okay, I'm only going to buy it on CPI day. I'm only going to buy it on NFP day, on Fed days, right? On Apple earning day.
Yeah,
right?
when something is supposed to happen.
Exactly.
And do you think that's skewing, do you see it skewing the actual pricing of the options you are in? Right? If those people aren't trading the 3 month option anymore, they're just going on those days. Is that bringing that vol down in those options?
It's definitely bringing down the wings. I would say at the money, if you talk to 95% of options traders, they understand realized volatility versus implied volatility, especially at the money volatility. That's very efficiently priced part of the volatility curve, right? The equivalent is, Apple. Most analysts know roughly where Apple should be trading, where Meta should be trading, Alphabet, right? They're over covered, and everyone knows, and there's minimal edge in actually doing like relative value Apple versus, another big blue chip. That's the same with at the money volatility, where I think there's less coverage, less understanding, less ability to replicate is in the wings. So for example, many people can tell you, how do I replicate a portfolio that if the future moves up one tick, I make $1. If the future moves down one tick, I make $1 from, the strike. That's just a straddle, right? But less people will be able to tell you, how do I construct a portfolio if overall level of volatility goes up by 1 point, I make $1. If overall volatility goes down by 1 point, how do I make $1? How do you replicate that strategy? What is the price for that? Less people know that. Because less people know that, I believe it's less efficient.
And does that come back to that the VIX is not tradable, right? It's just an index. So it's a collection of all those prices. So if I'm trying to capture that 1% increase in vol, where do I go to capture that, right? Locally,
Yeah,
globally,
that's
in
part of it.
between.
And that's why people turn to the futures. But the problem with the futures is the term structure. You just get killed on the term structure.
No. And
On
it's still a
average,
future on that index. So I don't know if that
yes.
solves the problem either.
Yes. Yeah. Well, I mean, you can actually, that is a strategy that I know a lot of market making firms do, is trading the strip of options, which ends up actually being closer to a variance swap rather than a vol swap. And they trade that against the VIX futures. And if you do that, you do get a little bit of convexity by trading long the strip versus short the future, because you're long variance and you're short vol. So variance has that quadratic effect over the vol. Again, another place to find convexity if it's priced appropriately.
And what are your thoughts of how does a 4-man team trading in the most competitive market in the world compete with the Optivers and Peak Sixes and all these groups who have hundreds of PhDs, and it seems an impossible task, but that's the entrepreneurial spirit you wanted to pick up.
Exactly. So it's something that I picked up at Optiver, which is, if you're going to do something, do it to completion. Don't spread yourself too thin. It's tempting, for example, right now let's go out and trade, oil options, right? With what's happening over in the Middle East right now. It's tempting to say, okay, let's stop trading S&P 500. Let's start trading single stock options. Okay, that's not working. Let's start to trade this. Let's start to trade that. What we do by that, is we don't diversify. We just stay in our lane, and then we just try to make it the best possible thing that we can. And then once we've kind of maxed that out, then we decide, do we create a new strategy or do we trade a new product? And so right now our team is 2 developers and 2 traders. So my partner and I are both the traders, and our 2 other employees, they're developers. And so the developers, they're really focused on, how do we make operating as smooth as possible? The back office, sending out the confirmations, making sure that the reconciliation is fine. I think with a firm our size, market risk isn't the biggest risk. A 20% move in S&P isn't going to blow us out. What will blow us out is if we don't know what our position is, or if we think we have one position, but we actually have another position. And that's why this focus on reconciliation, this focus on back office, this focus on having automated processes to remove human error is crucial. And so it's like having that, dedicated focus to risk, in addition to making money, which I think helps us, I wouldn't say be better than the big guys, but at least compete amongst them. Because we're going after a different piece of the pie, because we're not shooting for those nanosecond trades. We still connect over the internet through our third-party software through to the server exchange. So we are hundreds, if not thousands of milliseconds behind, the true high-frequency traders.
But would you argue that's your edge in a weird way, right?
Exactly.
They're so focused on this that they're ignoring this other part.
Exactly. And when people ask us, okay, you're a market makers, but then, how do you still market make? The main source of edge is that we're not overfit, because we don't have to continuously provide liquidity. And that's the biggest difference. We can be selective about when we provide liquidity. And that's our edge, if you will.
But isn't the market makers, is that a bit of a misnomer? They don't have have to continuously provide liquidity either. Like they have to make their partners money and whatnot. But right, and you see that in April, they just pull all their bids and offers. They're like, this is too crazy. I'm on the sideline.
It's not that they don't have to, it's that they've built their business that the more they're able to provide liquidity, the more money they make.
Yeah.
So
But I think that's
because they've invested in this infrastructure, because they have, you know, a one-to-one traded to dev. I know we're one-to-one traded to dev as well, but the fact that they have all this overhead, anytime they're not in the market, they're theoretically just burning theta at a partner level, right?
Yeah,
if they're not providing quotes in the market, yet they can sit out, but they're just burning theta for all the rent that they're paying for the on-prem calculations, you know, for the army of people that they have working. That's why they need to be in the market the whole time as well. That's why there is a nice synergy with, you know, with exchanges and market makers, because, you know, exchanges are there to be able to provide the opportunity for liquidity, and it's the market makers that provide liquidity. And what we do is we also provide liquidity as well, because we do believe it's a service that we're providing the overall economy to get a better price for, you know, whatever they need to trade.
In my opinion, there's the retail trader is right thinking they're like a utility and they're going to provide this liquidity at all times. So yes, they have an economic incentive to provide liquidity as frequently as possible, but at some point that tilts, and if it's a really crazy market, they're going to blow out the spreads, all this stuff. Where the retail trader to me doesn't quite understand that of like, no, I need to go in there and see a 5-tick wide option spread at all times.
Yeah, yeah. And, you know, I think that's, you know, understanding the spread and how that relates to liquidity. And I think, you know, when I, you know, to take this to talk about, you know, my investment philosophy and just like the general like ethos of how the markets work, I think liquidity is the biggest driver of everything. It's the driver of risk. It's the driver of reward, performance. Everything is about liquidity. Following the flow is just following where the liquidity is going. If there's a lack of liquidity, there's an increase in risk. That's why the bid-ask spread widens out. I think the Fed's measure of liquidity is actually not just how many bonds transact, but it's also the bid-ask spread that dealers quote. You know, it's all driven by liquidity. And you can talk about fundamentals, and you can, you know, like stocks are now at all-time highs. There are, you could argue, a lot of headwinds, but the biggest tailwind is liquidity, right? And so whatever, you know, risk or reward that people try to pin down to fundamentals, at the end of the day, my belief, the main fundamental that drives everything is liquidity.
And you could care less where it comes from?
Exactly.
Yeah.
Where you kind of start to care about where it comes from is if the liquidity starts to change. For example, right? Like if you have an asset where in a lot of, you know, high liquidity times, people are pouring their money into that asset, but in low liquidity times, people aren't pulling out from that, then that's a great asset to own, because it's going to go up in good times and it's not really going to come down in bad times because people aren't pulling out in that. If you have another asset where it's going to go up a lot because there's a lot of liquidity, people are pouring in, but when things become less liquid, people pull out from that, well, then it's just playing chicken, right? It's like, I'm going to ride it, and then, oh, liquidity's gone, boop, get out, right? And so understanding, and, you know, this is what value investing tries to be all about, right? The idea is that when there's a lot of liquidity, just pick up your value and own it. But then when there's no liquidity, those companies are still good. Like you're still going to get your dividend. They're still, like, you know, if you think about like your Walmarts, you know, your Costco's, you know, the consumer, like the non-discretionary stuff, right? That stuff's going to be there. And so, you know, you're understanding that liquidity. Same thing with options. Same thing in the volatility space, right? Like what's going to be there day in and day out. And if it's not in vogue, what could change? For example, like skew, right? skew to the downside, yeah, it's going to get expensive. Yes, it's going to get expensive. And then if we have a sudden crash, are people going to start buying calls over puts? Like, probably not, right? Like, yes, once you've found the lows, and let's say, for example, the Fed injects a bunch of quantitative easing again, just like they did in March and April of 2020, did we suddenly see call skew in the S&P 500? No, we didn't, right?
Yeah.
So
People
it's
are
like
still
these
scared of the downside.
Yes, right. And so we have this like permanent effect of flow causing these levels, right? So, it's understanding how much that flow has pushed that asset price. And I'm considering skew on S&P 500 like an asset, because you can trade that. What price is that? And is it going to get cheaper? Could it get cheaper, and could it get more expensive? And just understanding those dynamics.
Do you have any worries that we've created a monster, so to speak, and the whole derivatives market, the options in particular, are almost larger than the underlying, right? And if we keep going on this direction, right, and the CME, who knows, they could launch hourlies, or like they're for profit. They'll just keep launching new strikes and new ways to trade it. So when does it become a problem, or do you think it will ever become a problem that the derivatives overwhelm the underlying?
It's quite topical that you bring this up, because you see the current lawsuit that's happening over in India right now.
I didn't know of it. Yeah.
Okay, so that's an example of where the liquidity in the options market dwarfs the liquidity of the spot market. We see that in other equity indices like Korea, where there's an extreme amount of liquidity in the options or the derivative space, and there's less liquidity in like the cash markets. Now, in terms of whether that is going to be a disaster that melts down the financial system, probably not. There's too much regulation around that. But it does make it more susceptible to manipulation. It does make it more susceptible when you have something that's leveraged, and anything that's leveraged up, you can kind of take a big position in whatever's leveraged and influence it by a minimal amount, right?
Yeah.
And that's not to say that only happens in the options market. You could see that happening, before the 2008 financial crisis, right? Everyone was levering up on, on these mortgage instruments and things like that, and they were just super levered. In the good times, they were making a killing, but then in the bad times, yeah, it went quite awry. So in terms of the overall like financial safety of the markets, I don't think we're too big. In fact, I think like in the US anyway, the cash market is very robust. There's a lot of regulation around that. And if anything, I welcome this additional education, this awareness about options and people trading it, because I do believe the options market and the derivatives market is the cleanest form of insurance on the financial markets. Right? I view, coming back to my actuarial background, I do view options as insurance instruments. And your ability to buy and sell them is the same as your ability to buy, not so much sell insurance. You'd have to be like an insurance company to take that side.
And real quick, what was the Indian lawsuit? There some company that had lost money was blaming the option traders or something?
So the backstory was these two traders left this proprietary trading firm to join a fund because they said that they could replicate this strategy. And then the proprietary trading firm said, no, you guys stole this strategy, so we're going to sue you. And then in the courts, it was revealed just how much money they were making. And then the exchange decided to investigate, like, how did they make so much money? And it turned out that they were taking leveraged bets in the options market and taking advantage of the fact that the cash market was less liquid than the options market.
So they were moving the cash market, basically.
Yes, yes. That's what they're being accused of. Yeah.
Well, which you could argue was like GameStop and that kind of thing. Like at some point, yeah, the market makers need to hedge, and they're going to start buying
Yes, yeah, and that's what the proprietary firm is saying. They were hedging, that they needed to do this, et cetera, et cetera. So it's I think that came out over the weekend. It'll be interesting to see how everything actually unfolds.
Super interesting. All right. So what's next? So S&P for now, but what would be next once you get that?
So word has it that the CME will start listing single stock futures this year, and then after that they'll list single stock options.
Single stock future options. Yeah.
Yes. So the
Well, they
reason
already
why it's
have
so
single
exciting,
stock futures, but nobody trades them, right?
yeah,
A
and then
few.
when you start adding the options, then it becomes exciting because the most exciting thing for us is actually beneficial to our investors because of this section 1256 rule in the tax code,
Yeah.
which says that if you trade derivatives on futures, all your gains and losses will be taxed at 60% long term and 40% short term. Whereas if you trade single stock options, they're considered equities. And so if you buy and sell them within a year, then you're taxed completely at short-term capital gains. So there's like a tax advantage to moving over to the future space.
Do you know the background of that? Is the Chicago traders used to, if they had a loss on the year, they'd exit at the end of the year.
Yeah.
And take the loss. If they
I
had a gain,
actually don't know the history of that. I just know it as a rule.
Yeah.
Yeah. I mean,
that's the history. If they had a gain, they would just hold the position for their like March futures. If they had a loss, they'd sell. So basically, no one ever had a short-term gain of all the futures
got it.
traders. And some
And so then
IRS and
they
one of the big
doing
traders got
mindset.
it, and that was the deal. Like,
Ah,
hey, you guys got to stop doing this. And they're like, no way. And they're like, well, okay, the deal is futures trades can be 60-40. Just
got it. Yeah.
trade as much as you want, and you can treat it as 60-40.
Yes. So we don't hold anything over a year. So, that's why it's a nice rule for us, because we try to provide liquidity for our investors as well. So we have a 30-day redemption period.
And then this is all in a fund as of now? Will you do SMAs, or what does all that look like?
We have one SMA and our fund, and right now it's like an even split. Yeah.
We'd like to take a little fun turn here and ask you if you could go back in time and witness/trade one market event, what would it be? Where do you think you'd have some huge edge?
Huge edge. I think it has
Or
to
just
be.
if you wanted the front row seat. Yeah.
I think it would just be a front row seat. The Black Monday, what was it, October 19, 1987, I think. Just being on the floor and seeing the chaos unfolds. I know that kind of seems a bit, evil of me, but just to see people's like put skew positions just blow up. Seeing their calls increase in value on the downtick because vol is just getting so big.
Ooh, that would be brutal. Yeah.
And just seeing just the chaos unfold, seeing how the cool, calm, and collected prevail, I think that would have been an awesome experience just to learn from that. And because that was groundbreaking in terms of the market's leading academia in terms of, hey, this is what actually should happen, right? You had the best and brightest minds of, Black and Scholes saying that, okay, this is the assumptions that go into our model. It should be a flat vol surface. And then on that day, that's the day that was credited for the vol surface, for the vol curve, the volatility, smile, smirk, skew. And I think to see that kind of event cause, it was a new shift in the quantitative finance world. I think that would have been awesome to see.
We'll put a link in the show notes. We wrote a blog post once. I think Brett Hull Trading was a Chicago prop firm for a long time. He was a floor trader in the MMI index, which was like the precursor to the Dow futures. And basically everything was shut down except for that small pit. And he bought like 10 contracts at the lows, and that basically started the whole the uptick. And then somebody saw it and said like, oh my God, this price, there's a bid there. And so I'm going to buy this stock here. And it basically got the bottom and got everything rolling back up. So I think the
Oh,
blog post
okay.
was like how futures save the world.
Yeah. Oh, that's cool. Yeah.
But to that point of like, it was a derivative on an index on the stock. So the
Right, right.
derivatives driving it.
Yeah.
Love it. All right. And what do you see? We'll leave it with what do you see for the rest of the year? Tariffs, you don't care if it's crazy
It
down, crazy up.
what we're
What's your
following is liquidity. Like what could cause liquidity to seize up? I follow M2, like the money supply quite closely. Credit default swaps. Those are because I'm much more concerned about like the global. Like, should I be adding more global convexity to our portfolio? Right now, I don't see any need in the next 2 to 3 months at least. Seems quite quiet. Yes, you might get the occasional little shock here and there. I don't always expect us to keep grinding higher, even though we do. But yeah, it's just like what would cause liquidity to change in a meaningful way.
yeah.
We saw, when the Fed tightened in 2022, yeah, that was a little bit of a liquidity event, but it was more so people taking, some froth off the top, right? You did see that M2 money supply down. That's why it was probably one of the calmest sell-offs in the past 3 decades or 4 decades or something. Like it was the lowest level of that the VIX got to when the annual year-on-year move was over 20% downwards in the
Yeah, it
S&P.
was which killed a lot of vol traders, right? It was just a
Yeah,
vol-less sell-off.
they were long their puts, and then they were long futures against it, and then the puts never went in the money. They just got crushed on the vol and then crushed on the deltas. They just get crushed all around. Yeah.
Yeah, I
So
think if you bought the 20% out of the money put at the beginning of the year, right? And whenever in September when we hit down 20, it was basically the same price.
yeah, it's wild, right? It's wild.
Hence,
Yeah, there was
hence the
just no
name.
fear, and that's when yes, liquidity turned, but it was never like a shortage of liquidity. So that's the big question that I'm constantly asking myself. It's what's going to be the change in liquidity, and that's why yes, it kind of does matter, like where this liquidity is coming from, and what's going to cause them to pull out. One thing that I'm looking at right now is a lot of the private markets, private equity, private credit. We saw, Harvard's endowment fund was trying to liquidate some of their private assets. Is that going to cause, if there's liquidity tied up in there, does that mean they have to come to the public markets to liquidate? Right. So it's
we had a head of the Baylor University Endowment saying they're moving less out of privates more into public markets because they're worried about the capital calls and just basically the
yeah, yeah.
illiquidity. And
So
there haven't been
if
dividends in that
anything, that's
space.
actually a liquidity boost then for the public
Yeah.
market,
Yeah.
which is, and that's why it's such a tricky game. But if there's not as much debt, if there's not as much leverage in the market, and with the advent of AI and there's a lot of productivity from it, then there's no reason why we should experience a significant drawdown, a significant liquidity event. But when that changes, when you start to see signals on the horizon suggesting otherwise, that's when you really want to, be prepared. And that's why I think the options market, people trading the derivatives, they have such a nice insight into be able to trade these alternative assets that really aren't linked to the delta anyway of equities of, whatever underlying that they're trading.
We need liquidity futures.
Yeah.
Then we could just be like, all right, I've got
Yeah.
puts on
Yeah.
liquidity. I'm all good.
Yes. Yeah.
We'll tell our friends at the
Pitch that to the
CME.
exchange. Pitch that to the CME.
Awesome, Bernie. I think we'll leave it there unless you got anything else you want to throw in there.
No, I think I'm good. Yeah.
Awesome.
Thank you
Thanks for
very
your
much.
time.
I appreciate the opportunity.
Yeah, we'll talk to you soon.
Have a good one, Jeff.
I think you're coming down to our Cubs event, right?
Perhaps, yeah. Perhaps, yeah.
All right. We'll see you there.
See you, Jeff. Have a good one.
Thanks, Bernie.
Bye.
You've been listening to The Derivative. Links from this episode will be in the episode description of this channel. Follow us on Twitter at RCMAlts and visit our website to read our blog or subscribe to our newsletter at rcmalts.com. If you liked our show, introduce a friend and show them how to subscribe. And be sure to leave comments. We'd love to hear from you. This podcast is provided for informational purposes only and should not be relied upon as legal, business, investment, or tax advice. All opinions expressed by podcast participants are solely their own opinions and do not necessarily reflect the opinions of RCM Alternatives, their affiliates, or companies featured. Due to industry regulations, participants on this podcast are instructed not to make specific trade recommendations nor reference past or potential profits, and listeners are reminded that managed futures, commodity trading, and other alternative investments are complex and carry a risk of substantial losses. As such, they are not suitable for all investors.